And so joining me now to talk more about the economy and the market is Joyce Huang, Senior Client Portfolio Manager of Fixed Income at American Century Investments, a firm with more than 40 products trading here on NYSE ARCA. Joyce, great to have you. Joining us remotely from New York this morning. And what is the market telling you at these levels?
Yeah, thanks for having me. And I also have to say I am a fan of the Olive Garden as well.
I like that.
One thing talk about the consumer, we still see our base case scenario as a growth scare or economic slowdown. And what concerns us at American Century is that at these valuations, I don't know if the equity markets are really pricing it in. As a fixed income specialist, we have seen rates back up a little bit, especially on the long end, as the tax bill has been proposed and passed through the House. So, we do have some lingering concerns that we don't think are fairly reflected in the market. And to your point about the consumer, we have seen a pullback, especially from that lower to mid-tier consumer dining out, shopping. So we expect that the hard data will eventually start to soften through the summer into the fall.
Okay, so what could that mean for the equity market, Joyce? I know you're saying that the bond market is sending one signal, but the equity market perhaps hasn't caught up just yet. What could our viewers then expect from stocks?
I think it's going to remain volatile, right? Because we do have that 90-day pause from the original tariff announcement on Liberation Day. We do expect more and more announced as the weeks extend and get to that July 4th final deadline from the original extension. But every day, there's different news that comes out. Like you mentioned today, we had PCE come out a little lower than expectations, which matched the CPI report from last month, which is all rather positive. However, you have to take the hard data with a grain of salt because it's not reflecting the potential effect of the tariffs. So I wouldn't be surprised if you saw equity markets kind of flat to stable through the summer. Usually they say sell in May and go away, right? So We'll see what happens this summer.
Okay, so I do want to ask, since you are following the rate market here very closely and fixed income in particular, what we might be able to gauge from the Fed. There's so much focus here in the equity markets as to how the Fed will adjust its interest rate policy amid some of this data. What more can you share there?
Yes, I don't envy Fed President Fed Chairman Jerome Powell at all. I think he has a very, very tough job. And he's really trying to navigate a rock and a hard place because we don't have the hard data. Unemployment still remains relatively contained. However, again, we do expect that the tariff pressures, rising prices are going to continue to press consumers. The Fed, we believe, is probably at risk of going too late to continue their rate cut cycle because they don't have the evidence in the hard data. Unemployment, their second mandate, has not shown the signs of weakness they really need to see before they cut. And while inflation has moderated, it is still slightly above the Fed's target. So we do want to be a little bit cautious in bringing forward the Fed rate cuts. I know at the beginning of the year, people were saying, maybe they'll start by June. We don't think that is likely. We believe that we will probably see 2 rate cuts this year, and they will be backloaded. So September through December.
Yeah. So then with that in mind, Joyce, what do you think is the best way to position oneself in this market?
Yeah. So, a lot of investors we found have still been scarred by their experience in bonds in 2022. So a lot of people move to cash or ultra short. But at this point, we're seeing actually more opportunities in the short duration space. So let's say 2 to 3 years, but then also adding back a little bit to that core rate area. So let's say 5 to 7 years. That will act as a buffer to equity market volatility. But then by being in the short end with more credit-oriented strategies, you can get more yield. I mean, you can get close to 6% yields on investment-grade short duration bonds. So that's extremely appealing in this market.
Joyce, great to get your take. Again, Joyce Huang joining us from New York. She's a Senior Client Portfolio Manager of Fixed Income at American Century Investments. Thank you.
Thank you.